What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my favorite series on the channel where we talk about all the stocks that I purchased or sold last month, which was, of course, January 2022. We also talk about all the stocks I'm thinking about buying or selling this month here in February, which is, of course, the month of love. So happy Valentine's Day to all you lovebirds out there. By the way, it's also the month of my birthday, so you guys gotta be nice to me down in the comment section, or at least just wish me a happy birthday. You could say, I hate you, you suck, but you know what, happy birthday. And if you do that, I'll leave a heart on the comment, I promise. I'm just kidding, by the way. The vast majority of you guys are super nice, and we always have a great time down in the comment section. I actually consider a lot of you my friends, which I'm gonna stop saying sweet stuff now and talk about stocks. I'm a man, we don't share our feelings, we talk about stocks. That's what we do. So turning to stocks, when looking at the stock market right now, we're in kind of this weird phase where I feel like we are experiencing quite a bit of volatility in the stock market, and that can be a little scary at times. Right now, the economy, in my opinion, is looking pretty bad. Interest rates are expected to rise, which is causing, in particular, I would say, a lot of highly valued stocks, and especially tech stocks, to really struggle. And buying into some of those stocks, in these kind of conditions, sometimes you don't know if you're just buying into a little dip that will recover, or if you're buying into something that could turn into a bigger correction or even crash. But personally, I gotta admit, I actually kind of like these conditions because I'm usually thinking long term anyway. So if I can kind of pick and choose the different stocks that I want to own and make adjustments to them through the volatility, and especially on any dips that come, and I can pick up some lower prices, well, that can actually be a good thing for me if I'm just planning to buy them now on lower prices and hold them long term, and I can kind of navigate my way through that volatility. And I think that's what's going to happen here in February. I feel that the market is going to continue to be a little volatile, but I think that's going to give me some buying opportunities for some stocks long term. But we'll talk a little bit more about this as we make our way through the video, and especially when we get into the February part. But let's go ahead and start with the January part first, and I'll talk to you about all the moves that I made in January, and then we'll cover what stocks I'm thinking about buying here in February. Okay, so starting with January, I made purchases in 4 different stocks, all of which were already existing positions, and I did not do any selling. So quickly running through the list, I first purchased some more of Duolingo, ticker symbol DUOL, and it wasn't for any really special reason other than I just felt like I needed to lower my cost basis a little, because Duolingo is more so just a spec stock for me at less than 1% of my portfolio, and I decided to add a little more at around the middle of January at just under $92 a share, which definitely did help my overall position since the stock eventually climbed back up to above $100, leaving my overall position slightly positive by, about 2%. The stock itself, though, has been very volatile after IPOing last year and is currently down by over 50% from its highs, which is why I started to buy into it myself. I just thought it was a decent price considering that they're the world leader in language learning apps with typically more than 60% market share, and they have a pretty good opportunity to expand into other learning subjects too. So far, their strategy has been working with revenue growth of around 100% in recent years, although that was likely boosted by people staying home during the global health issue and using virtual learning as a substitute. And despite that boost, they are still not currently profitable, but I'm probably going to hold this spec stock long term anyway as a very small position just because they do have some decent future potential, and I want to see how that plays out for me. Probably won't be buying any more in February though, because it did already climb back up a little bit, but we'll see if anything happens with volatility. Next up though, I also purchased some AT&T stock, ticker symbol T, at right around 26 bucks a share, and the reason for that was just because it's been falling a lot lately. It's currently near the bottom of its 52-week range and down about 28% from that 52-week high. My purchase wasn't that great though, because the stock is even lower now. Anyway, there are several reasons for the poor performance, namely the spin-off of Warner Media and HBO Max that is combining with Discovery to form a new public company that will compete more heavily in video streaming, which will result in AT&T having to cut their dividend by about half later this year. But even then, you're still going to get stock in both companies, and even with the dividend cut, AT&T will still be yielding around 4 to 5% at today's prices. So I just think today's price is pretty reasonable, all things considered. I'm probably not going to buy any more in February just because I like to keep my AT&T position very limited in my portfolio because of all the risk that they have as they try to restructure their businesses. After that, though, I also picked up some more of Palantir, ticker symbol PLTR, which is often thought of as a sort of software like defense contractor for the United States and the government, but they really provide all sorts of services to not just the United States, and even other countries, but they also market to many companies as well. In fact, their commercial segments for business continues to grow faster each quarter over the past year, going from 4% to 19% to 28% to 37%. And in the United States alone, that segment grew by over 100% last quarter. So it's kind of on fire. I mean, you could say that. So I would say that this, in combination with getting exclusive contracts with the US government and the military, that has really helped them achieve large growth rates as a whole, usually talking about around 30 to 40% each year, which is pretty good. That total growth is slowing down a bit though, because it was boosted by the health related contracts that they got during the 2020 with the pepperoni situation and all of that. But that's already caused the stock to crash all the way back down to a 52-week low, which is right around their original IPO price. Now, to be fair, a lot of that crash was actually caused by Reddit traders that were pumping it up before they sold out of it, causing the stock to crash. But even then, I just think that at these prices, the sell-off, no matter how you want to, justify the sell-off, I just think that it's way overdone. And the price is very attractive, I would say, from a long-term perspective. So I went ahead and bought some more shares at a few different prices. One was at around $15, and then I bought heavier when it fell to $12. I'm not sure if I'll be buying any more here in February, but if it does dip at all from here, I could actually see myself buying a little more just because I do plan to hold this one super long term, and it is one of the stocks that I actually really like. And then the final stock that I purchased was Facebook, ticker symbol FB, or I'm sorry, I guess they're actually called Meta now. But that's because they're trying to shift a lot of their focus over to creating virtual worlds in what is referred to as the metaverse. In fact, they already invested over $10 billion last year alone on developing the hardware and software for the platform. And some analysts, including Bank of America, they estimate that they will have to spend at least $50 billion on it over the coming years. That is actually no problem for a company like Facebook, though. Over the past year, they've done over $100 billion in sales, with over 40 billion of that going straight to the bottom line. And they're still expected to grow their sales by about 20% next year, despite already being so massively large. Which, by the way, diving into the metaverse is exactly what an already giant and well-established company like this needs to do in order to find new growth in the future. I honestly feel that Facebook stock is almost always a buy if you're thinking long term, but I went ahead and purchased some more shares at just under $300 a share. The stock has since climbed back up above that, but even here, it's still around the midpoint of its 52-week range, so I'm still interested in it, but I'll especially be buying it in February if it happens to dip back down into the 200s. Anyway, let's move on now to the stocks that I plan to buy here in February. And really the biggest issue that I have right now, and you guys will know this, you've been watching my videos, I've been buying way too many spec stocks over the past like 1 to 2 years. Too many speculative, kind of unprofitable companies. And the issue that I have with that is that I only allow less than 10% of my portfolio to be allocated to spec stocks. And I've kind of been filling that up a lot. And so I need to move a little bit away from that and start buying some safer, more stable companies, especially those that pay dividends. The reason I was buying a lot of spec stocks is because I just felt like that's where I was seeing the better deals out there coming out of the recession and through the global health issue. I felt like the more stable, reliable companies weren't seeing as many dips. They were all just kind of steadily rising. Of course, there are exceptions to everything I'm saying, and there were times where I could have made better decisions. But overall, I just saw big drops in a lot of spec stocks, and I just felt like their prices were too attractive to ignore, so I was buying a lot of those. But moving in here into February, I think we need to switch things up a little bit, start investing in a little bit of some safer companies, or at least some that pay some reliable dividends. I would like to have that, more of that in my portfolio to kind of balance out some of the speculation that I've been adding to it. So for the month of February, of course, any stocks that are dropping or dipping, I'm going to be looking at them. But just kind of at the top of my list, there are 3 stocks that I'll throw at you that are high up there on my list that I will be looking specifically throughout February. I have purchases that I want to make on these stocks. And One of them is an energy company, another one is a large conglomerate, and another one is a biotech pharmaceutical. All of them pay very attractive dividends, in my opinion. So let's just quickly run through those and then I'll wrap up the video. Okay, so first up, we're going to go with the renewable energy stock known as Next Era Energy, ticker symbol NEE, who I've always liked but was never really able to catch them at the right price as it was usually trading very expensive. And that's actually still the case today as their valuation is around 50% more expensive than the sector when you look at various metrics. However, most energy stocks are valued very low, which it makes it hard for Next Era to compete or compare with on a valuation basis. But when you factor in the future growth with a PEG ratio, which is where renewable energy companies tend to shine, when you look at growth over the longer term with them, well, when you look at that ratio, they are actually slightly cheaper than the sector, which is pretty good. Now, you also have to look at the stock itself and realize that it's currently dipping pretty hard. So far this year, the stock has crashed by 18% from its highs. That's pretty big for a stock that usually climbs pretty steadily. Here's a 10-year chart to better illustrate that. And yeah, you can see right here, it's usually climbing very smoothly, it's super uptrending. Anyway, what I love about NextEra is that they are not only the largest electric utility company by market cap, which provides more stability as people always need electricity even during weak economic times, but they are also the world's largest producer of solar and wind energy. And because of that large investment or commitment to renewables, including another $50 billion being spent through this year, NextEra has been able to experience larger profit growth than the average energy producers that typically grow by very low single digits, if at all. But NextEra, on the other hand, they not only did more than 10% EPS growth last year, but they also averaged about the same amount over the past decade, which, by the way, during that time, not only has the stock crushed both the S&P 500 and the utility index, as you can see on this chart here, that compares the gains of all three across various time periods, but NextEra has also, all the meanwhile, been paying a dividend that currently yields about 2% with a double-digit growth rate and a whopping 26 years of consecutive growth. I can't say for sure whether the stock will go up or down from here in the short term, but if it dips even just a little bit more in February, I think I'll be ready to start buying some of this one myself for the long term. Okay, next up, I'm also thinking about buying some more of 3M stock, ticker symbol MMM. And you want to talk about a stock that has crashed hard? This is a stock that was once trading for around $260 and has now fallen by over 35% down to just $165. Now, I already own 3M, but I'm actually up about 20% on my own position because I initially bought it during the 2020 crash around that time. But I'm interested in picking up a little more now because not only does 3M own very popular household brands like Post-it notes, Scotch tape, various others, but they're also diversified into several different markets like auto care, industrial, and even health and safety, including the very popular N95 mask, during this whole global health issue. Now, the stock has struggled though because of how much those products are tied to the macroeconomy, and there's been several lawsuits against some of those products that have only made things worse and kind of scared away investors during all of this time. But while 2019 was a down year, they actually stabilized in 2020 despite the recession, and they proceeded to recover by a whopping 10% in 2021 and are now back to their low growth of around 4% a year. Sure, that growth is very low, no denying that, but that's not really why you're buying the stock. The main reason, or at least for me, is because they're a dividend king with over a 3.5% yield that has been grown every single year for more than 6 decades in a row. Now you combine that with the falling stock price that leaves the valuation at one of the cheapest levels in a while at just around a 16 forward P ratio, and I think this stock is starting to look pretty attractive to me. And I'm definitely keeping an eye on it here in February. All right, and finally, the last stock of the list is Merck, ticker symbol MRK. And I've actually been talking a lot about this one lately because I actually really like them. But I'll just keep it very short here and to the point. Merck is a giant biotech pharmaceutical company doing tens of billions of dollars every year. They're solidly profitable. Their growth can be low at times depending on the year. For example, 2021 is only about 1% growth, but here in 2022, they're jumping back up to almost 17% growth. But that's thanks to a couple different reasons, but I would say notably it's their gigantic pipeline of close to 100 different products, and that's on top of the already 6 blockbuster drugs they had in 2020, with Keytruda alone doing over $14 billion that year. Now the stock is very slow moving, but it does tend to be a little volatile, kind of jumping around the $70 and $80 ranges. Right now, it's around the midpoint of its 52-week range, just above 80. And I love to buy this stock in the 70s. So I'm hoping that it dips more so kind of back into the 70s again here in February. And that's where I really want to start picking up some more shares. And I actually already set it up an alert on my phone to give me a notification if it drops there. But ultimately, the reason I own this stock is for the dividend, which currently yields about 3.4%, has a low payout ratio of below 50%, and has reasonable growth of over 8% a year, considering that it's been growing for more than a decade straight. Again, I love it in the mid to low 70s, but if I can just get it kind of anywhere around that price this month, I'll be very happy. I really love this one for the dividend. But there you have it, guys. Those are all the moves I've been making, the moves I plan to make. Let me know what you think down below. If you have any suggestions for any other stocks, I'd love to hear that as well. And maybe I can talk about those stocks in the future. I'd love to do that. But thank you so much for stopping by. I hope you all have a great month here in February. I wish you all a lot of success, and I will catch you in the next video. Thanks again. I'll see you later. Bye-bye.